Tilray brand stock has been smoking hot in recent weeks. In just a few months, it went from less than 40 cents back in June to trading at more than $2 as of Thursday's close. It's a remarkable performance for the cannabis and alcohol company. And recently, it did something I haven't seen it do in a long time. Normally, Tilray brand stock rises in value when there's talk about marijuana legalization or potentially marijuana reform in general in the US. Usually, it's the company's actual earnings performance that drags the stock down. But on Thursday, which is when Tilray reported its latest earnings, it jumped by 22%. That's a rarity because normally when its earnings come out, it's usually not good news for the stock. Between a lack of profitability and limited growth, there's normally plenty of bad news around the business and reasons to be bearish. But lately, investors have been feeling bullish around the company. So what's behind this recent rally? And can it hold up? This past quarter was the first quarter of fiscal 2026 for Tilray. The headline numbers were that its revenue rose by 5% to $209.5 million, and that it also posted a profit of $1.5 million. And its adjusted EBITDA rose by 9% to $10 million. Let's break this down a bit more. It generated top-line growth. Its alcohol business has been fairly flat overall, but a lot of growth came from its cannabis business, which sounds good. But if you go back to last year, its cannabis revenue actually declined by 13% from more than $70 million in the previous year, 2023. So Tilray is going up against some weaker comparables than it was a year ago. So if you compare cannabis sales on a 2-year basis, Tilray's cannabis revenue is still down 8%, $64.5 million versus $70.3 million back in 2023. Meanwhile, last year, its revenue increased because of acquisitions in its alcohol business. This time around, that didn't happen. The distribution business, which is mainly CC Pharma, involves selling pharmaceutical products internationally. That too showed some decent growth this quarter, but at $74 million, also is going up a lackluster performance last year when sales in that segment declined from $69.2 million to $68.1 million. Ultimately, there's been a lot of noise on Tilray's financials in recent years due to acquisitions and market conditions. It generated some modest single-digit growth, but when you consider that its cannabis business had the benefit of going up against some weak comparables from a year ago, it's not as impressive as it might appear to be at first glance. Now, what about that bottom line though? Tilray did post a profit, and a lack of profitability is undoubtedly a big problem for cannabis producers these days. At $1.5 million, it was incredibly slim with respect to revenue of nearly $210 million. However, it was a big improvement from a year ago when its loss was $34.7 million. But let's break down why this happened. There are two big line items responsible for the turnaround. One is amortization. Amortization is a non-cash item, and a year ago, Tilray incurred $21.8 million in amortization expense versus just $3.9 million this period. That's a swing of around $18 million in cost savings this quarter. A lower amortization expense can be due to the company slimming down its operations and getting rid of its assets, but it's a non-cash item nonetheless. The second item was a $15 million change in fair value of contingent consideration. This is due to its acquisition for Montauk Brewing. This again is a non-cash item. It's an accounting entry to reflect updated fair value calculations. Investors can't count on this to recur in future quarters, and so while Tilray benefited from it this time around, that's likely not going to be the case in the future, in which case Tilray is likely to slip back into the red. This is what you'd call poor quality earnings because they're not likely to be repeatable. The most important number, I think, for cannabis investors to focus on is the day-to-day operating cash flow. This tells you whether the business is actually generating positive cash flow from its day-to-day operations. Over the past 3 months, Tilray's operating cash flow was a negative $1.3 million, so it's still burning through cash. But the good news is that it's far less than the $35.3 million it burned through a year ago. Now, I'm not a Tilray fan or investor, but I can admit the company did show some decent improvement this past quarter, as it has pivoted more towards alcohol that has made its operations a bit more stable, and there should be a better chance of profitability in the long run than, say, competing in a highly competitive cannabis market in Canada. What I don't agree with, however, is that this is worthy of a 20% jump in value. Tilray did okay, but I think investors are getting a bit carried away between the overblown hype around marijuana rescheduling, which I've mentioned in the past won't directly benefit Tilray in any way. Until full legalization actually takes place in the US, Tilray won't be able to enter the US market. It's just that simple. And that can still be several years away from happening, if at all, regardless of what happens with respect to rescheduling cannabis. If you strip that away, then there isn't much reason to be excited about the stock. Its growth is limited and it's still not truly profitable, and its cash flow is still in the red. Tilray may not be grossly overvalued like some AI stocks out there, but it's still not a bargain buy or a cheap buy either. And that's because there's still loads of risk with the business. Where will its growth come from if the US market doesn't open up? Is it going to continue acquiring second-tier beverage brands that other alcohol companies don't want? That just doesn't sound all that exciting. Tilray's stock is hot right now, but so are other meme stocks. But that doesn't make them worth investing in. The danger is that sooner or later, Tilray and other stocks will come back down to earth. And when that happens, there could be a lot of pain for investors who misread the situation and assume that Tilray's on a much better path than it was a year ago. It isn't. It's made some progress, sure, but by no means is there some tremendous growth ahead, or will profitability be the norm going forward for Tilray. It still isn't a safe buy, and if you're going to buy it and you're bullish on this rally, just be aware of the risks and what you're getting into, because its recent results were okay, but they were nothing to get this excited about. Anyway, let me know what you think about the stock in the comments. Do you think Tilray's still heading higher, or do you think it's hit a peak? Thanks for watching, and please leave a like and subscribe for more videos.